Ever wondered how you can tell what a company is truly worth just by looking at one single document? Well, today we're going to pull back the curtain on that exact document, the balance sheet.
It's a huge question, right? Can one piece of paper really give you a clear snapshot of a company's entire financial health at one single moment in time? The answer? A big yes. And that's exactly what we're going to break down right now.
So, what is this magic document? Well, it's got a pretty fancy official name, the Statement of Financial Position. But you and I, we just call it the balance sheet.
Seriously, the best way to get your head around it is to think of it like a photograph. It's not a movie, right? It's not showing you what happened over weeks or months. Nope. It's one single, perfectly still picture that captures everything a company owns and owes on one specific day.
And at the very heart of this financial photo is one simple, totally unbreakable rule. An equation: assets equals liabilities plus equity. Basically, what a company owns, its assets, has to be paid for by something. And that something is either money it owes to others, its liabilities, or money from its owners, which is its equity. So let's start taking this puzzle apart, piece by piece.
Okay, first up, let's talk about equity. The easiest way to think about this is the owner's slice of the pie. It's the company's net worth, It's what would be left over for the shareholders if the company sold everything it owned and paid off every single debt.
Now, when you dig into that equity section, you're going to see a few key terms, but don't let them intimidate you, okay? They're really not as complicated as they sound. Each one just tells a different part of the story about how the company got its funding in the first place.
And check this out, because there's a really cool strategy at play here. A company gets permission, it's authorized, to create a maximum number of shares. But, and this is the key, it almost never issues all of them at once. Why? Well, by keeping some in the back pocket, it gives them the flexibility to raise more money down the road without having to go through a whole new, long approval process. Pretty smart, huh?
So, when those 7 lakh shares actually get issued, they each have an official, kind of nominal price tag called a face value. In our example, it's just 10 rupees. So, on paper, the starting capital is 70 lakh rupees. But, and this is a big but, that's almost never the whole story. See, in the real world, shares sell for whatever the market thinks they're worth. And in this case, each 10 rupee share actually sold for 30. Whoa! That extra 20 rupees per share, that goes into a special pot called the share premium. So instead of raising 70 lakh rupees, the company actually brought in 2.1 crore. That is a huge deal. It's a massive signal that the market has way more confidence in the company than its simple book value suggests.
All right, next piece of the puzzle, liabilities. This one's pretty straightforward. If equity is what the company owes its owners, liabilities are what it owes to everyone else. We're talking bank loans, bills from suppliers, all the money it has to pay out.
But here's the thing, not all debts are the same. They're split into 2 really important groups. And the line that divides them is a super simple but really powerful idea, the 1-year rule. It's as simple as this. Current liabilities, those are the debts you've got to pay back within the next year. Non-current liabilities, that's everything else. All the debt that's due after that 1-year point. And this little split is absolutely critical. It tells you in a heartbeat what a company's short-term money pressures look like versus its long-term game plan.
Okay, let me give you a perfect example. So, a company takes out a 36 lakh rupee loan that it's going to pay back over 3 years, right? On this year's balance sheet, that first 12 lakh payment, the one due in the next 12 months, that's listed as a current liability. The rest of it, the other 24 lakh that's due in years 2 and 3, that gets listed as a non-current liability. See how that works?
All right, so we've covered what the company owes. Now let's get to the fun part, what the company actually owns. We're talking about its assets. These are all the resources, all the stuff it has, that can be used to make money in the future.
And guess what? That same 1-year rule we just talked about, it applies here too. Current assets are all the things the company expects to turn into cash within a year. And non-current assets, well, those are the big long-term things it plans to hold on to for way more than a year to actually, run the business.
Think about it. Cash in the bank? That's the ultimate current asset, right? But non-current assets are your heavy hitters, like buildings, factories, and machinery. I mean, sure, a company could sell its factory, but then how would it make anything? See, the whole point of these assets is to hang on to them for the long haul, to generate value year after year after year.
Okay, so we've looked at the 3 big pieces: equity, liabilities, and assets.
Now let's bring it all home and see why that word balance in balance sheet is seriously the most important part of this whole thing.
And this, right here, is the magic. That equation, it always has to balance, always. Think about it. Every single thing a company owns, every asset, had to be paid for somehow. It was either bought with borrowed money, which is a liability, or it was bought with the owner's money, which is equity. The two sides of the scale have to be equal. It is the one unbreakable law of accounting.
So there you have it. You now have the decoder ring. The next time you look at a balance sheet, you won't just see numbers. You'll see the story behind them, the company's strategy, its risks, its potential. So the question for you is no longer, what on earth does this mean? Now it's, what story is this balance sheet telling me?